Last week, the S&P 500 climbed above 5,800 points for the first time, but we saw some stocks that still really struggled. We have Tesla down 13% on the week after what the market considered to be a flop for their highly anticipated 10/10 event, and we also see Google down 2.4% after still hanging over their head is the DOJ probe. Now, we also pointed out in yesterday's episode that the S&P 500 does currently trade at a fairly high P multiple, sitting right now at 30.38. And therefore, really, in today's episode, we want to take a look at 10 undervalued dividend stocks and consider whether we should buy these. As always, we'll look at each one at a very high level. We'll talk about their earnings, how they've performed, their expectations moving forwards, as well as a quick snapshot of their dividend safety and some other metrics that can really highlight whether or not these should be strong considerations in our portfolio. And as always, with each one, we are going to run them through the valuation model, getting to our own intrinsic value, what MOS level we see for each one, and how much upside Wall Street see themselves over the next 12 months. Now, a few things just to highlight on what happened during the week. We saw inflation come in marginally hotter than what the market wanted, 2.4%, consensus was around 2.3, therefore there is a little bit of worry of how much Jerome Powell and the Fed will in fact cut in the November decision. Will it be the aggressive 50 basis points or will it be 25 basis points? And we did hear from one policymaker who did in fact suggest they could skip cutting rates in November altogether. And when we do take away food and energy, we can in fact see that overall it did increase to around 3.3%, which is 0.3% higher than the previous month. So there is some thinking for Jerome Powell and the Fed to do in next month's meeting. We also mentioned this, but it was considered a bit of a flop. Elon Musk discussing what they are expecting over the next few years. They had the 30,000 Tesla self-driving Cybercab, as well as Optimus Prime, a robot that they are expecting can do a lot of things for the consumer, again priced around $30,000. And as we can in fact see here, he does believe the Cybercab will be producing before 2027. It is a question though, is he doing the typical over-promising and under-delivering, or will we really start to see some progress from this company? As we mentioned, the stock did get hammered. Just on Friday alone, it is down around 9%, and over the last 12 months, down 17%, with all three analysts still giving this company a hold. And if you want a deeper dive looking at the valuation, we did release a video just yesterday. We also noticed the market hasn't really moved from last week. We are sitting in between both greed and extreme greed, so just a word of caution. Nonetheless though, this shouldn't really impact your overall investment decisions, and we just want to highlight we were sitting in fear just 1 month ago. Now, in terms of next week, very exciting, lots of massive companies that are reporting. We will cover the majority of these and any large movements on the channel. We have Bank of America, UNH, Walgreens that are reporting before the market open on Tuesday. And as we can see, lots of big names. ASML, very important in terms of the semiconductor industry as a whole. And sticking to this industry, we do also have Taiwan Semiconductors reporting before the market open on Thursday. Now let's jump into the more interesting part of the episode where we're looking at 10 undervalued dividend stocks. The first one in the oil and gas sector, it is TotalEnergies. Now this is up around 3.9% over the last 12 months. Over the last 10 years, as we can see, up only 22%, so you would have underperformed the S&P, but as always, will depend at which point you did buy. For example, COVID lows, this was trading at just above the $25 mark. Now it is trading in the mid to lower end of the 52-week range. We get a strong buy from Seeking Alpha, a buy from Wall Street, and a typical hold from Quant. This does have a fairly attractive dividend yield at 4.88% and a fairly low forward PE of 8.34. In terms of their expectations, well, do note this industry as a whole is very cyclical, but the next 4 quarters, only one of them they are anticipating growth to the earnings per share, with next quarter, Q3, double-digit negative EPS growth year on year. And we also note out of the previous 4 quarters, they've only beaten 2 of the 4 times, 50% track record, with the more recent quarter being a 10-cent miss. Nonetheless, over the next full year, they do expect EPS to increase, with the forward PE estimating to be 8.21 in December 2025. Now, in terms of some high-level metrics, they do have a dividend safety score of 50, borderline safe. This ultimately means there is a possibility of a dividend cut over a next full economic cycle. In terms of the yield, it isn't too far off the 5-year rolling. That is essentially telling us a reasonable valuation. And on the PE basis, we do get an overvaluation. However, we will look in our model shortly. And nice to report, just this year, they did increase the dividend above the 4% inflation at 6.8%. All while you are, as an investor, getting a nice 4.88% yield. Now, in terms of this company, we do get to our intrinsic value at $97. And as always, when we do our deeper dives of each one of these companies, we run through the inputs and the outputs of each model. We're going through 10 today, so let's get straight to it. Intrinsic value at $97 with a current price of $68.80. We always on this channel like to do MOS. 10% to kick things off, wide moat, strong financial metrics, good forward-looking data, and then we're happy to use that 10%. In today's episode though, for TTE, we do get a nice MOS, so we keep going till it's near the current trading price. And for this oil and gas company, we see a 30% margin of safety, and whilst Wall Street has a lower target over the next year, nonetheless, they see 18% upside, which you could consider to be very attractive. You're getting a 4.88% yield. They did just increase the dividend by 6.8%. We do believe a substantial MOS level, with Wall Street, as we said, giving this a fairly attractive upside. As always though, do give us your thoughts as we go along these stocks in today's episode. Now, before we move on to the next one, just to let you know, we have released our latest free weekly article. We deliver one every single Monday to your inbox, where we talk about what's happened in the market over the last few days, as well as undervalued stocks that we do believe deserve your attention. So do click on the pinned comment below to sign up, and we will be releasing the next one on Monday, and you also have access to read all of these today. On top of that, you will be able to access 22 undervalued dividend stocks that have the most upside according to Wall Street. And for the month of October, as every month we do release undervalued stocks, you will be able to gain access to 36 stocks that we do consider to be a buy for this month. Lots of information about them, how much undervalued they are, what is the upside from Wall Street, and we also talk about those that sit within our own portfolio. So do go ahead, click on the pinned comment below, sign up, and you can read straight away. Now, the next stock near 52-week lows, it is United Parcel Service with a double buy from Seeking Alpha and Wall Street with a hold from Quant. We do also have another attractive yield at 4.91% with a forward PE sitting just above 18. Over the last year, not great, down 13%. Over the last 10 years as well, up around 37%. So underperforming of the S&P, and we can pretty much see all-time highs January 2022, more than 2 years ago, at $225. Right now, it is trading nearly half of that value. In terms of their earnings expectations, well, not only are they anticipating growth over the next 4 quarters, they also believe 2 of those, quarter 1 and quarter 2 of 2025, to be strong double-digit growth. And when we do look back, they have a 75% track record of hitting their earnings. Notably though, they did miss by 20 cents, quite a large margin, just in the more recent quarter of 2024. Moving forwards though, large growth anticipated, 8.9 EPS estimate for December 2025. As we can see, will lower that forward PE to just above 15. In terms of dividend safety score, we get a 69. We get a massive undervaluation signal on the yield, as we can see, significantly higher than that 5-year rolling. And in terms of PE, we get a reasonable signal. Very disappointed, as we have discussed before on this channel, their dividend increase at 0.6% in this year, significantly below inflation, and pretty much they wanted to do that just to keep up those years of consecutive growth. Now, in terms of our intrinsic value at $149, we can see Wall Street pretty much have a very similar number, where they see 10% upside over the next year. In terms of our margin of safety, well, at 10%, we see this as a buy pretty much around the current trading price. Whether or not, though, UPS, which has suffered in the more recent quarters, deserves a 10% or more, as we can see, that is it for today's episode. For those that want to see, to put it on their watch list, 15% a buy at 126, 20% a buy at 119, and 25% at 111. As we said though, today's episode, 10% MOS with 10% upside, and as always, you can grab a copy of this model to run your own numbers through, whether it's for UPS or any others that you do desire. We then move on to Diageo PLC with a buy just from Seeking Alpha and a hold from Wall Street and Quant. We can see trading towards its 52-week lows with a yield of 3.07%, a forward PE just below 20, and over the last 12 months, down around 13%. Over the last 10 years, up around 19%. In fact, if you had bought at the COVID lows, it was around $110. We also note, though, all-time highs pretty much sitting at the back end of 2021, $220. Very similar to UPS, trading nearly around half that value today. In terms of their earnings, we don't have any historical data, but we can see over the next full year, they do anticipate an EPS increase to 7.25, which will lower that forward P down to around 18.6. In terms of dividend safety, well, the highest score obtainable at 99, very safe. Yield severely showing undervaluation, as well as severe undervaluation based on the P model, and we can see they did increase that dividend just over the last full year at 5%, marginally higher than the 4% inflationary target. In terms of valuation, well, our value of 143 isn't too far off Wall Street. They have 146 with upside of 8%. Remember, they did give this a hold. And if we look at it on the MOS calculation, a buy at 128. So right now for this company, we only see a 5% MOS. For those that want it at 10%, well, a buy at 128. Not too far off. It could happen over the next few weeks. At 15% at 121, 20% at 114, and then as we can see, 25% $107, which was around the COVID lows. Today's episode, though, just 5% with upside of 8% over the next 12 months, according to Wall Street. We then move on to the Toronto Dominion Bank with a double buy seeking alpha Wall Street, a hold from quant, trading in the mid to lower end of the 52-week range. They were down over the last week. They did have allegations of money laundering, and right now the yield does sit on a trailing 12-month basis at 5.3%, with a forward PE just below 10. Now, over the last 12 months, it's down around 5%. Over the last 10 years, up around 20%. And we can see all-time highs over 2 years ago at $85. Now, in terms of their earnings, only one quarter they're looking to see growth to the earnings per share out of the next four. And when we do look back historically, they have beaten or been in line 75%. The more recent quarter, Q3 2024, a very marginal miss of 2 cents. Nonetheless, marginal growth anticipated, lowering next year October the forward P to 9.65. In terms of dividend safety, nice to report a safe score of 70. Dividend yield, we can see undervaluation. Again, it is above that 5-year rolling line. Undervaluation on the forward P estimation, and a very nice above inflationary increase at 6.3% just in November. So over the next few weeks, we're anticipating another increase. And this is also nice when you are getting a fairly attractive yield from TD. Now, in terms of their valuation itself, our intrinsic value of $73 gives us a nice MOS, because at the 10% point, a buy at $66, at 15% around $62, and in today's episode, we see at least a 20% margin of safety around the $58 mark, although we do know Wall Street do have a lower target, $64, where they see 12% upside, and some of these that we are reviewing today may be attractive for those that do look to take that yield and use it on their income external from dividend reinvesting and putting it back into other companies. We then move on to the Hershey Company with a triple hold rating right across the board, trading at the lower end of the 52-week range, a forward yield that is nearly touching the 3% point, and a forward P sitting below 20. Now, over the last 12 months, it is down around 3%. Over the last 10 years, up around 103%. We do notice it has come down ever since its all-time highs from last May at $275. Now, in terms of earnings, out of the next 4 quarters, 3 of them they're anticipating growth, 2 of them, in fact, double-digit growth to the EPS. And out of the last 4 quarters, whilst they do have a 75% track record, 3 out of 4, they did miss fairly substantially just in the more recent quarter 2 of 2024. In fact, one thing that we have to highlight with this company, they are anticipating the EPS over the next year to fall, although marginally, increasing that forward P to just above 20. Now, in terms of dividend safety, there is an 80 score, so it is safe. We have severe undervaluation on the yield, severe undervaluation on the forward P, and a very attractive and fairly consistent increase of the dividend at 15% from the Hershey Company. In terms of the valuation, well, we do get our intrinsic value at $215, where if we do put it into the MOS calculation, at 10% a buy at $193, at 15% not too far off at $183, not quite there yet, but sitting near the 10, more so the 15% mark. For those that want it at 20% at $172, again, this is something we could see. It has been downward trending for quite some time. So 15 to 10% in terms of MOS, with Wall Street indicating around 11% upside, their price target of $207. And one of the main reasons we have seen this company falter over the last year, the increase or sharp increase in cocoa prices has really hurt this company's margins, as that is one of, if not the main ingredients for their products. Something though to keep an eye on, as this is, for those that do like dividend growth companies, historically a very strong one. As always though, give us your thoughts as we go along these stocks today. We then move on to PPG, a dividend king with a buy rating from Wall Street and a double hold from the other two analysts, trading towards its 52-week lows, a forward yield on the lower end today at 2.12%, a forward P of 15.6, over the last 12 months down 3%, over the last 10 years up 36%. We can see a bit of a roller coaster, went down to around the $85, $80 mark, and then we see all-time highs around 3 years ago at $180. Now, in terms of this company, well, nice report over the next 4 quarters, every single one, growth anticipated to the earnings per share, 100% track record, either in line or beating targets, and they do, unlike Hershey, expect EPS growth, lowering that forward PE to 14.18. In terms of dividend safety, very safe score, undervaluation on the yield, undervaluation on the forward PE, with an inline increase to inflation at 4.6% in July this year. When we get to the valuation, well, $149, giving a margin of safety at 10%, a buy at 134, at 15%, not too far off, and a dollar shy, so we can say 15% MOS for this dividend king. With Wall Street, they do like this company. Their price target $152 over the next 12 months, giving this upside of 19%. Then we move on to one of my favorites, GPN, Global Payments Incorporated, with a double buy from Seeking Alpha and Wall Street, a hold from Quant, trading right there towards its 52-week low, a yield of around 1%, a forward P of 8.66, down around 13% over the last 12 months. Over the last 10 years, outperforming the S&P, up 178%, but we can see it hasn't recovered from all-time highs more than 3 years ago at $215. Right now, though, it is trading less than half that price we saw. In terms of moving forwards, well, what better than double-digit growth anticipated to the EPS over every single quarter over the next year? Also, even though it is marginally outperforming estimates, giving them a 100% track record, and EPS expecting to continue lowering that forward PE to 7.79. Dividend safety also does look good, sits at a 70 safe score. Dividend yield theory giving undervaluation on the forward PE, but we do have to point out they haven't been increasing those dividends for the last 3 years. In terms of the valuation of this company, well, we have an intrinsic value at 138.90, Wall Street 138.70. They see 42% upside. That is very strong for what we do deem to be a fairly high quality company. In terms of MOS, well, a buy at 125 at 10%, at 20% a buy at 111, at 25% still looking like a buy. So in today's episode for GPN, we give this a 30% MOS with Wall Street, as we can clearly see, very bullish on this over the next 12 months. As always, give us your thoughts below, and if you are enjoying the episode today, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. We then move on to another dividend king. It is Hormel Foods Corporation, with a buy rating from Seeking Alpha, a hold from Wall Street and Quant, trading towards its 52-week lows with a yield of 3.64%, a forward P just below 20. Over the last year, very poor, down 14%. Over the last 10 years, up only 24%, as we can see. But also remember, with all of these companies that we are reviewing, this doesn't include if you had reinvested your dividends, then this performance would be up slightly higher. Nonetheless, not great over the last 10 years. Out of the next 4 quarters, 3 of them anticipated growth, and they have also had a 75% track record. Nice to report though, the last 3 quarters were beats, even if they were marginal, and they expect that EPS train to continue to increase, lowering that forward P to 18.43. Nice, or very nice in fact, to report the dividend king with a very safe score of 90, severe undervaluation on the yield, severe undervaluation on the forward PE, with a mediocre increase to the dividend last year at 2.7%, again an increase expected over the next few weeks. Now, in terms of HRL, we do get our intrinsic value at $36, which does give an MOS, well, 10% a buy at $32, at 15%, not quite yet there, so somewhere between that 10 to 15% mark. With Wall Street, their price target of $35, giving this a buy with upside of 13% in today's episode. We then move on to another oil and gas company. It is Beyond Petroleum, BP, with a double buy signal and a hold from quant. Again, trading towards the lower end of the 52-week range. One of the higher yielders today with a yield of 5.6%, forward P of 8.2, down around 17% over the last year. Over the last year, also down around 22%. As we can see, if you had picked this up at the COVID lows of around $50, you would be up around double. In terms of their earnings, only one of the next four grows, so that is a 25% estimation in terms of increases, and over the last 4 quarters, 3 of them have been in line or at least a beat. December 2025, they do expect nice growth overall, lowering that forward PE to 7.1. We have another borderline safe score to the dividend at 50, undervaluation on the yield, undervaluation on the forward P, and as we can see, very nice and attractive 10% increase to the dividend in July this year. In terms of our valuation, well, $44, same as we can see for Wall Street, where they see 38% upside over the next 12 months, and ultimately we will have a nice MOS level here at the 20% mark, a buy at $35, at 25%, pretty much around where we see it now. That is pretty attractive, a nice increase to the dividend this year. We also can see nice MOS at 25%, nice upside of 38% as well, and as we did say at the beginning, very nice starting yield too. We then move on to Nutrien Limited with a double buy rating and hold from quant. We get it trading towards the lower end of the 52-week range, 4.4% yield today. As we can see, pretty much the majority of the stocks today have had a nice yield. Do let us know though in the comments if you prefer companies with a higher yield or those with a smaller yield but more in terms of share price growth over the longer term. We get the forward PE sitting just below 13. Over the last down around 20%. Over the last 5 years, we can see down around 4, but again, will depend when you bought. And in fact, all-time highs around 2 years ago, $115. Right now, it is trading less than half of that at 49. When we look forwards, we do notice 2 of them, they expect decreases to the EPS. However, the next 2 quarters, they're anticipating large double-digit increase year on year. And we do know they have missed 2 of the last 4, although the previous 2, quarter 1 and quarter 2 of 2024, have been beats. And they expect EPS to increase moving forwards, lowering the forward P to 12.5 in December next year. In terms of dividend safety, well, a 41 borderline safe score, undervaluation on the yield, undervaluation in terms of the forward PE, and we get a fairly mediocre increase in February this year to the dividend at 1.9%. Now, our intrinsic value is $65, marginally higher than Wall Street. They have a $62 price target over the next year. Very appealing growth of 27% to the share price. And when we look at it from an MOS perspective, well, 10% a buy at $58, at 20% a buy at $51.84, at 25% pretty much where we see it today. So definitely one to consider. 25% margin of safety, 27% upside. As always, if value was provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Don't forget to sign up to the free weekly newsletter below where we are sending out next week's edition on Monday morning. You can grab those 2 spreadsheets as well. And if you want, come and join us in the Patreon where we do talk about our weekly buys and sells. As always, have a great day and we'll see you all on the next one.